Hello everybody. This is Christian Sarkuni, and I will be the moderator for this panel about opportunities in distressed debt during the pandemic. A little bit about myself. About 10 years ago, I founded the first food ordering platform in Italy, which turned out to be the most successful startup in the space. A few years later, I sold the company and I started working as a private investor, focusing on uncorrelated debt strategies and sharing my research with a few family offices. So I'm really excited about the topic of this panel. We are all aware of the profound disruption that this pandemic is causing to our lives and our economy. And this is the first pandemic we are facing in modern times, and the level of uncertainty about how the situation will unfold is just unbearable, I would say. So there are too many variables, and we really don't know how bad the economy will be impacted and how long it will take for it to recover. We don't even know if and when the virus will leave our lives. But what we do know for sure, though, is that no matter what the central banks and governments do, no matter how much money they print and how they distribute this money, an increasing number of people will delay and default on their loans, and more companies will declare bankruptcy, as is already happening actually. So there is no doubt that this is a grim environment for investors, especially for those who have exposure to the most affected sectors. And however, there is a good news. The good news is that this disruption is also generating unprecedented opportunities that we are going to discuss with our guest panelists. So let me introduce the first guest. Let me be a gentleman, so I will introduce the only lady we have on the panel, which is Aradhana from Hong Kong. Can you hear us, Aradhana?
Unmute.
Absolutely, I can. Hi, Christian.
All right. Hi, how are you doing? What time is it there?
It's very early in the morning or very late in the evening. Depends on how many glasses of wine you've had.
Yeah, I can imagine. So can you give us a brief introduction of yourself?
Absolutely. Hi, everyone. My name is Aradhana Dayal. I'm based in Hong Kong. I run my single family office out of here. I set up about 25 years back, moving out of India, which is where the family was based. Used to be a large land-owning agriculture family. We set up a family office about 25 years back. That probably makes me, one of the oldest gray-haired person on the street, and certainly the first female CIO. So I really kind of had to earn my stripes, but it was a fun journey. We primarily invest in real estate in Hong Kong and also increasingly Australasia, Middle East. We do everything from high-end residential to commercial to agriculture, actually farmlands in Australia and New Zealand. And about 10 years back, we went into a very exciting new area, which is industrial buildings revitalization. So our idea with that really was that small businesses need exciting, low-cost, slightly eclectic, fun office working spaces, and we could create those for them in the disused industrial buildings, away from very, very high-priced CBD areas. That has been very successful, and we've sort of created a prototype for Hong Kong. We are very well loved for that. Yeah, we've done about 18% annualized for 25 years, so it's been a good journey. Apart from my single family office, I also run Access Alts Asia. It's an Asia-focused investment club I founded about 4 years back. My husband calls it my expensive hobby, but in all seriousness, it's more than that. It's really, you know, a network of 300 plus highly evolved business families and international investors around the world, and we look at unique opportunities all across.
Okay, great. You seem to be very busy. So let's go with the next guest, a panelist, Brian from Safe Harbor Equity. You want to introduce yourself briefly, please?
Yes, sure. Thank you, Christian. As Christian said, my name is Brian Prenovo. I'm the Director of Investor Relations and SEC Compliance at Safe Harbor Equity. My background in investor relations has been about 12 years. I actually spent 5 years on the sell side covering real estate investment trusts, and have now been with Safe Harbor Equity just over a year. Safe Harbor Equity is a private equity firm that targets distressed commercial real estate debt. We do not really look at the residential mortgage market, but we specialize in the strategic acquisition, origination, management, and repositioning of non-performing asset-backed commercial real estate mortgages.
Okay, that's good. Thank you very much. I appreciate that. So let's go on with Bill from Spurs Capital.
Hello. Good afternoon. Everyone can hear me, right?
We can.
This is Bill Bimel. I'm the managing director at Spurs Capital. Spurs is a seasoned whole loan mortgage investor. We do in the residential mortgage space what Safe Harbor, Brian's company, does in the commercial space. We have offices in New York, Florida, California, and Colorado. We have been in the business since the last downturn. Our strategy is oriented towards Wall Street meets Main Street. We utilize our connections on the secondary market to be a liquidity provider to larger institutional investors, banks, holders of non-performing loans, NPLs. We only buy first lien NPLs, and we primarily only buy single family residential houses and condos. We do this either buying one loan at a time, but we more often buy small pools. We play in a $5 to $15 million range as a liquidity provider. And then the Main Street aspect is that we have boots on the ground in all 50 states to reach out to borrowers, look for what they're interested in seeing as possible resolutions, possible rent reductions in principal, loan modifications, cash for keys, waivers of deficiencies, whatever we can offer a borrower to help them through their distressed situation. And in doing so, we speed up timelines to create an amazing arbitrage for our investors. We've placed close to $1 billion in equity since 2011 through 5 managed funds, mostly with institutional partners. We returned an average of 15% annualized return, non-levered, and we are about to launch our 6th fund, which will be an LP offering this summer, obviously in anticipation of opportunities that we are already seeing in the market today.
All right. Thank you very much. I appreciate that. And eventually we have Luis from Brian Invest.
Hello, Christian. Hello, everyone. I hope you can all hear me well.
We do.
Trying a microphone today. Well, I'm from Brainvest Wealth Management. We're a multifamily office founded in Geneva by Brazilians. And today we have offices there in Geneva. In Brazil, we have 2 offices in São Paulo and Rio, and 1 here now in Miami. We have around $2 billion of assets between all those offices. We have a heavy focus, especially for offshore investments. When I say offshore, like outside Brazil, we have a heavy focus on alternative assets. We started doing that at the beginning of last decade, like 2010, 11. And today our clients invest from everything from music rights to real estate in Ireland, and airplane leasing here in the US. So we have a long track record now on alternative investments, and we like to go like real deep on them. We're just don't invest. We do like a big due diligence on every fund we invest. We visit all the, for example, real estate the funds have, and we like to be very close to the managers we choose to invest in.
That's good. Okay. Well, thank you very much, Luis, and thank you all for the introduction. And I will jump right into the panel. And let me remind that there is a Q&A chat, so I encourage the audience to ask questions anytime, and I will take them later during the panel. So the first question is for everybody, and it's a general question which brings us to the core of this discussion. I would like to ask all the panelists, what changes have you seen in your business since the pandemic started? And what opportunities do you see lying ahead? So who wants to go first on this?
This is Bill Bymel is here. I'll start with that question.
Right,
it is quite a broad question, so I may only answer the first part of it. We have obviously seen some tremendous opportunities already. I have seen opportunities, as a result of some of the liquidity freezes that happened about, in the last few months. I'll give you one example. I'm not really a commercial NPL or performing loan buyer, yet I was offered a pool of low LTV performing commercial liens, mortgages on credit tenant properties, low LTV. This stuff would normally trade in the secondary market at a par or 102 all day long, was being offered to us by an investor that had to deleverage, and we were being offered these performing low LTV loans at 90s of UPB. That's just one example. On the residential side, the fix and flip loan market has really exploded in the last few months, and I mean in a bad way. A number of lenders have gone out, a lot of lines have been called, and because of the private nature of these business purpose loans, the loans to that are higher interest hard money loans to investors, fix and flip or buy to rent programs, it is a very private market, so there's not a lot of transparency into default. And I will tell you from my personal relationships that the default rates, even pre-COVID, on a lot of these fix and flip loans was already in the double digits.
Okay. Maybe.
Yeah, and I think I wanted to maybe piggyback off of what Bill was saying on the commercial side. So far, I think from Safe Harbor Equity's standpoint, it is not as much a change in the deals that have come as of yet, which although we do expect that to happen, but so far in the last, call it 4 to 6 weeks, it's really been an issue of volume. We're just seeing a lot more opportunities coming our way, and kind of to Bill's point, I think there's just a lot of either brokers or banks, trying to sell the assets as soon as possible before things get really bad. But from our perspective, looking at the commercial market, we're just seeing a tremendous uptick of incoming calls. And then I would say, especially probably in hospitality, that seems to be where a lot of the calls that we get are coming from people looking to either sell or JV or partner into something in the hospitality sector. Because I think universally or near universally agreed that is likely going to be the hardest hit.
I see.
I agree with Bill and Brian from fund managers' perspective. Everyone's saying that the opportunities are everywhere, that they're seeing stuff that they never saw before in their lives. But from the investor side, like a lot of people are still waiting to see what's going to happen in coming weeks and months because nobody knows. So we're trying to balance that with our investors, like, because the opportunities seem really good, but they still prefer to wait, and then we have to show them what kind of returns and protections they have when they invest in those opportunities that are rising now.
All right. So thank you, Luis, as well. And I will say, so talking about opportunities in real estate, we have two different realities represented here. We have Brian from Safe Harbor that spoke earlier, and he works with commercial mortgages. And we have Bill from Spurs Capital that works with residential. So I would say that both have been impacted, perhaps with a different timing, but I would like to ask which asset class is more attractive in this environment? I want to put a little bit of competition.
Yeah, Brian, you can start if you want, and then I'll counter.
Okay. Most attractive.
Yeah.
I guess it sort of depends on what. Right. I guess it depends on what your ultimate goal is, right? So if you think that hospitality is most likely going to be the hardest hit, at some point there's very likely to be extremely attractive opportunities. I would say at Safe Harbor, at least within our funds with our LPs, we actually try to stay away from hospitality because hospitality has such a business behind it that from a risk reward standpoint, for our funds at least, that is not what we're looking for. So it's particularly attractive, and I think that's even evolving week by week or even day by day. Whereas typically we would look at industrial and office probably being the lowest risk, multifamily being relatively low, then maybe followed by retail. Now even office is a much riskier proposition than call it 6 weeks ago. So I guess from an opportunity and what's the most attractive, I would say most likely industrial, multifamily would probably give you, I guess in our estimation, the best risk reward outlook.
Yeah, I agree with Brian and his perspectives on commercial. We have been in this business. We've managed, placed close to $1 billion in equity since 2011 through these 5 funds we've managed. So we've been through this in downward markets valuation wise. We've been through it in upwards markets. And even in the last few years, when many of our competitors have had to leave the market because their returns have been squeezed because the market's just in a good place right now, or what was in a good place, we have been able to maintain a consistent mid-teen return to our investment partners unlevered. And so as far as, and I think both Safe Harbor and I have very similar short-term strategies, and we've built these amazing mouse traps where we can take a loan in, and it's a 30-year loan that's in default, work through it, fix it through loan modification, taking back the property, a consent judgment, some kind of waiver of deficiency, whatever creative techniques we can do. And in the case of loan modifications, we're able to repackage those reperforming loans and resell them to other investors because they're higher yield, and people that are in a seasoned reperforming loan tend to have much lower default rates. So we have been able to make money in all aspects of this market. Our average investment hold is about 14 months. And of course, real estate is a slow boat. So within a 14-month time frame, we can buy deals for at a significant discount now, work through it, and even with an anticipation of a plateau or a decrease in residential values over the next few years, we can still arbitrage nice opportunities. Obviously, the residential market, just in general, everyone needs a home. I think one of the things that COVID has taught us is the value of our homes. They're no longer just places to sleep and watch a movie, but they're now places where we work. They're, the ability to entertain people in socially distant ways. So long term, everyone needs a place to live, but maybe not everyone needs a place to go to an office anymore. So, that's what you need to think about in terms of asset classes. And I agree with Brian on the multifamily on the commercial side, and the industrial will maintain some strength long term as well.
That's actually very nicely put, Brian. You're so right. I think homes are safe, safe sanctuaries for everybody. And actually, I've spoken to so many millennials in the past couple of weeks, who probably did not want to own a home, and they all want to own homes now. So you're so right. I think COVID has really changed everyone's perspectives on what a home really is.
Right. And we're careful to treat our borrowers with a level of dignity and respect that they're not used to when they're defaulting on their loans. So we have built a paradigm for dealing with borrowers, and we really try to keep people in their homes if they're owner-occupied loans. And if we're able to take some payments and put them back to the loan, if the loan's underwater, we're buying it at enough of a discount that we can pass some of that savings along to our borrowers, keep them in the home, and it's actually one of the best returns for us financially as well.
That's very nice. All right. So I'll take this chance to ask you the first question, Bill. So from the audience, so how long will the process be for price discovery in residential NPL? And also, how would you model a purchase right now? This is from Ryan.
Sure. Very good question. On the residential side, we have always fluctuated our model based on the most recent data that we're receiving from MBA, CoreLogic, the realtors that we have out in the field. So it's very important that we stay ahead of the curve. Already a year and a half ago, we had plateaued the HPI portion of our modeling. So in other words, we assumed that there would be no further appreciation in most of the markets we were buying in. And in some markets, we've actually have plugged in negative HPI, meaning that we are expecting over the next year to see a drop of anywhere from 3 to 10% in property values over the next year. So as long as we're pricing to the anticipation of maybe a lower value, we're seeing our bids, we're backing our bids up by 5 or 10 points in some cases and still getting hit on stuff. And so there's enough meat on the bone that if we do our job right and we get these loans reperforming or resolved in 6 months, we will still be able to take advantage of prices not having fallen too much, if that's the case, as to what happens.
All right. Thank you very much, Bill. So yeah, at this point, I would like to extend a little bit the conversation and ask Haratna from Hong Kong to tell us something more specific about the distressed market in Asia, and especially what are the differences within the market in Asia and the American one?
Yes, that's an excellent question, Christian. So, if you look at Asia, this really is the world's largest distressed debt market. We currently estimate it around $2.1 trillion. And, I really see this as a once-in-a-lifetime opportunity for investors from around the world to actually enter Asia, particularly after COVID-19. The Asian economies have been in some sort of state of lockdown since kind of mid-March, actually since mid-February, I would say. And that has caused tremendous demand destruction, as I'm sure it has all over the world. But I think in Asia, because they started a lot earlier, the demand destruction has been that much longer. Now you add to that, crash in oil prices and a collapse in travel, consumption, and I think we have a perfect storm brewing. So over the next, I would say 12 months or so, I would say that corporate earnings, as we see more corporate earnings start coming out, corporate earnings will certainly take a hit. I'm pretty sure the credit lines are going to get stressed, and we'll see a number of defaults, bankruptcies, and of course, eventual restructuring. So in short, I feel that there's a very unprecedented opportunity for both global family offices and institutional investors to actually cherry pick distressed assets in Asia. I would say one difference between Asia and the US is that Asia tends to be a very high risk, very complex, not so developed market for distressed debt. And I think that local laws and norms can be quite tricky. So one really needs to have sort of, a little bit boots on the ground. And the other big difference, I always joke and say that in the US, you need to have sharp pencils and sharp elbows, to actually get, great deals done. But in Asia, you need a feathery touch. So many businesses in Asia still tend to be family run. So I think connectivity and a network, at a local level is absolutely key. Coming to which areas and spaces do you think we'll see most distress in? I would say areas like retail, hospitality, real estate, of course, airlines, infrastructure, manufacturing. I think all of these are pretty hard hit. And so I think they should all be on our watch list. In terms of geographies, I think China, starting with China, India, South Korea, Southeast Asia, I think these would all follow one after the other in terms of distress. I think when you were speaking yesterday, you asked me how best for US family offices to actually play Asia's distressed market. To be completely honest, I think that, for US investors to come in and actually cherry pick these distressed assets directly as deals would be really hard unless they have local connectivity. So, a great way to play Asian distress right now, let's say if you're looking at China, for example, is to look at REITs. I know that a lot of China REITs are now trading about 25 or so percent, discounts. And, if you don't want to be an operator, especially in a complex market with language, cultural skills, cultural barriers, REITs are a great way to get an exposure to, distressed real estate while not having to operate, your assets. And that's something I certainly know from personal example. I think another way is to really look at some of the good funds that are very strong in the region. Oaktree is just announcing a $15 billion distressed debt fund. And I think much of that would actually go to Asia. I would say, a quick word on India as well. So at about $210 billion, India is Asia's largest distressed debt market. And pretty much all the global players are here, with the, after 2016 bankruptcy law that actually came out and actually allowed, assets to go into insolvency. Pretty much all the global players came in and started getting a pie of the non-performing loan market. But it's also a tricky market, and actually it's one country of, $1 billion, 1.5 billion people, which actually has been in a lockdown since mid-March. So, Goldman Sachs came out 2 days back and is actually expecting a 45% contraction in the, in the economy. So that's significant, and I think there will be a lot of distress there. One final thing I would say, in terms of, when global investors look at Asia, and this is a question I get asked very often, particularly by family offices. And I always say that you should always keep in mind 4 factors if you're looking to really invest in Asian distress. The first very much is that know the local laws, right? Asia is a very complex, high-risk market. And so understanding the legal framework, insolvency laws, and how you can work around that to actually get your investments back is very, very important. Secondly, I would say know the management team and owners, how well they've treated their creditors in the past, what's their track record with their counterparts. That's super, super important. Thirdly, really build a knowledge of the local ecosystem. So get to know your company's customers, their suppliers, their counterparties, their reference checks, their banks, how they deal with all of that. It's very, very important, I think, particularly in Asia, which tends to be a slightly opaque and not just straightforward market. And I would say finally, just keeping an eye on changing landscape, and changing regulation. So for example, India came out with a rule just last week as a part of its relief measures after COVID, saying that companies will not be forced into bankruptcies for 1 year. Now, you can imagine for a lot of distressed investors going in, that can be very frustrating. So just keeping an eye on those changing dynamics post-COVID, as many of the Asian economies or countries, governments come out and announce reforms, so how that affects your investments is super, super important. So yeah, that's some of the factors that I think one should keep in mind, when looking at alien distress.
Thank you very much. So you would definitely recommend this asset class for international investors as well?
I honestly think it's an unprecedented, once in a lifetime opportunity. There's going to be.
I'm afraid
we lost her.
You. All right.
We can move on. She'll come back.
Okay, so let's go ahead. I have a question from Ismail. And in terms of opportunities for investment, does anyone offer a one-stop shop for distressed residential properties? Something where an investor can just invest and be sure to get a good return? I think
everybody thinks that. Everybody thinks that.
Everybody wants that. No risk.
Everybody wants an easy investment to just invest and get in a good return. But the answer to that question, was probably in line with one of the ones that Christian had for me with regard to access to this space. We are not for the smaller mom and pop investors. Obviously, this is a very equity rich investment. You have to have a lot of cash on hand. But there are some crowdfunding Reg A groups out there that, I could recommend. You have to be careful because you have to know who your manager is. We personally have $500,000 minimums in our subscriptions in our LP offering. So we're really looking at more like 7-figure investment partners. And I don't know. And I think that, I think that the commercial, fund, the Safe Harbor, Brian's fund, as well. I don't know what your minimums are, Brian. What are you looking for?
Our minimum is 7 figures. Yeah.
So at least $1 million or more. So. Yeah.
All right.
So, in Asia, I would say, we don't manage any third-party money, but Asia has a number of really, really specialist managers who know what they're doing in very specific markets. And if anybody has recommendations on that, anybody wants recommendations on that, you're very welcome to reach out to me.
Right. Thank you, Radna. So I don't have any more questions from the audience so far. And let me ask Luis. So I want to listen from him. So Luis, you are a family office. So from an investor perspective, where do you think good opportunities are right now? What do you look in a fund right now? What you're looking for?
We're looking for experienced managers that have a track record. Doesn't need to be like a real long one, or if it's a new company, at least the manager has a good track record. And the knowledge he has on the market he's in, because as Arnett said, in Asia, there are different laws, things change. In Brazil, laws change all the time, the rules keep changing. Even here in the US, things are different from state to state, especially for real estate. So it's really important to have a manager that really understands his market. And also, Since we're like a family office, we don't charge anything. We don't get any commissions or anything. We just charge our clients. We always try to get a lower management fee, lower performance fee, depends on how much we invest in the fund, of course. And as I said in the beginning, we like to be close to the manager, not to give him a hard time about his strategy. He'll be completely free to do his strategy, but to be close and understand what's going on so we can explain to our clients why the fund is down or up this month. And we usually, depends on the fund, of course, but we usually go for like a place in the fund's board if there's one, or investment committee, depends on case by case basis, but that's how we usually operate. And right now we're trying to avoid funds with big loan to value on their loans. Mm-hmm. So we have some kind of protection if things keep getting bad for more time than we expect. So if everything goes to zero, at least we have some real estate, some airplanes and other stuff around the world to try to sell later.
Or fly around in.
Yeah.
All right. So you said that you are looking for experienced managers and that low loan to value is key for you. And yeah. All right. So specifically, do you think that there are opportunities in Brazil and Latin America that are less or more attractive than in US?
It's really hard to tell because right now, apart from the COVID thing going on in Brazil, mm-hmm. politics is a real mess, and foreign investors are pretty much leaving the country as fast as they can. And we don't see many opportunities in Brazil that are different from what we have here. In terms of return, in Brazil will be higher, but in Brazilian money, but in US dollars, we're not mm-hmm. sure. So for loans and everything else. And as I said before, also in Brazil, rules keep changing. We never know what's going to happen. That's another reason foreigners don't like there. But yeah, I think there are opportunities, but you have to find the right people to invest for you, and that's the hard part.
All right, thank you. I appreciate that. So
I would just make one last very quick comment, Christian, if that's okay with you.
Of course, go ahead.
You know, I mean, of course, it's absolutely fantastic to look at funds, you know, that can be one-stop shop. But I would say there's absolutely no substitute for doing your own work, your own due diligence. And one key golden rule that I would say that I've always followed with my family office investing is to really, really think long-term. And this is a generic advice. It's got nothing to do specifically with the distressed debt, but I think it's especially more important, you know, in a time like this. Very, very simple. Do not panic sell your assets. If you think they're distressed, right now you can give them some TLC and really lead your companies, you know, through the crisis. It's possible to bring them back. Do not buy white elephants just because they're on fire sale. I think that's super important, and I can't emphasize that enough. Our family office has really only made 10 bets, I would say, in about 20 years, and we've just watched them grow through 4 market cycles. And that's really done very well for us. So I always say that, you know, be patient. This will pass. You know, you can make great bets, but they need to be very, very limited in number. Always remember that you're planting a seed for the next 100 years. So you need to just protect your stems and ride out the storms, and the leaves often grow back. So that's my 2 cents.
Thank you very much. So yeah, I had actually a question about timing, and you seems to be on the waiting side. So the question is, are you jumping into opportunities now, or do you think that you will have better buying opportunities in months from now? I don't know, 6 months, 9 months from now. This is for the whole panel. So
who wants? I can start with that. Go ahead, Brian.
Sure. Oh, thanks, Phil. Yeah, I think that's a good question. I think, at least from our perspective, unless something is just a slam dunk, home run, insert whatever other sports analogy you'd like into that, we're being extremely patient. You know, the long-term effects are still unknown. The you know, potential price correction in collateral is still unknown, and you know, we do value protection of principal above just about above everything else in our fund. So we are very cognizant of returns. And you know, again, kind of just to go back in our old Wall Street or investing adage, you know, we don't want to catch a falling knife. So again, unless something is, like I said, just an 100% guaranteed win, our bent right now is to be patient and to wait. And if that means we give up 1% or 2 or 3 on the upside because we waited until asset values began increasing again, then we are completely comfortable with that. So I do think it's going to take some time before the real investing opportunities are better well known, better analyzed, and better understood, while still presenting, you know, very good investing opportunities.
All right, thank you. You want to jump, Bill?
Yeah, I have a perspective on that. And I agree, if I'm in Brian's position on the commercial real estate side, 100%. You don't know how bad retail is going to get. You don't know how bad office is going to get. Certainly wouldn't get into anything that's like a land loan or a development loan. Residential doesn't move as quickly in either direction. So we have been buying for 10 years up and down, and we are buying now in small quantities. We are backing our bids up, as I had mentioned, 5 to 10 points below what we were bidding just 6 months ago. And in some cases, we're still getting hit. So when the opportunities are that good, we're going to move on them. To give some perspective on this, because I happen to have gotten into the distress business in 2008. So I was there, got a phone call from a fund manager out of Southern California. It was the summer of 2008. It was 3 months before the fall of Lehman Brothers. So while things were bad, they hadn't really hit, the shit hadn't really hit the fan, so to speak. And those guys were bidding at that time, that summer, they were bidding portfolios of new construction to perm loans in Port St. Lucie, and they basically had an opportunity to name their price on these trades. And so what that taught me was that the smart investor will be a little bit forward thinking and really take advantage of opportunities as others are sitting on the sidelines. It can be dangerous to pass on a deal now or this fall because you don't know where we're going to be 6 months down the road. So I just, you know, you kind of got to balance that out between obviously being cautious about certain asset classes, perhaps certain markets or places, you know, major cities versus suburbs, you know, these are all considerations. But the opportunities do exist now, and we're cautiously and carefully stabbing little deals here along the way, trying to work them out quick, and so far so good. The reason that we are preparing our dry powder this summer is, from my perspective, you know, the fall will be very similar to, or not similar, but will have it'll feel a little bit like the fall of 2008. I think reality has yet to set in. There's still a disparity between bid and ask on a lot of assets. You know, I listened to much of the webinar here today and yesterday, and, you know, people are going off of what they see right now, which is that rents are still being paid, and there's even new purchases of home loans that are being made. However, you know, these are trailing events. These things are really going to start to kick in over the summer and in the fall. And when the reality sets in that just even a small segment of the population has totally changed their paradigm about spending and living and how they operate, that's when we could see some real liquidity issues. And that's where it brings opportunity to guys like myself and Brian and Louise and Adrana, who have capital on ready to go. There will be tremendous opportunities in the coming months as a result of it.
All right, that was extremely clear. So we just talked about timing, and we also got a question about space, area, from Ariel, which is asking, she's asking, are there any particular areas of the USA that you look to purchase the distressed loans? And also, how do you source your deal flow? So which areas are more attractive?
So
are there
from our
states that are more, okay, go ahead, sorry.
Sorry, I would say, so from our perspective, we are a South Florida based fund. We have done most of our deals in South Florida, but we do look nationally and have the ability to purchase nationally and have purchased from all over the United States in the 15 years that we've been in existence. Having said that, we do typically look at high population density areas with high sales velocity, typically with relatively limited supply. So that's, from a geographic perspective, that's what we look at. But the second part of the person's question, the differences, especially within distress, are the legal ramifications from state to state. So you really do have to take that into consideration, because there is a litigation management component to distressed debt investing that you have to understand. There are judicial versus non-judicial states, and having a thorough understanding of what that means and how that can impact your time horizon is very important.
All right.
Very well said, Brian. This is Bill again. I agree with all of those perspectives. Very, very true. We have taken the path less traveled. You may have remembered the last presenter, Mr. Nick, was saying, they only want to stay in places like California, where you have, or places where there is non-judicial foreclosure. It'll speed up the timeline to foreclose. We have gotten so good at the foreclosure litigation management and the boots on the ground interactions with borrowers that we actually target the judicial markets. We've primarily been 30% in the New York tri-state area, 30% in Florida, and then we buy loans in all 50 states. But we like judicial states because of the extra discount that we can derive from purchasing loans with those anticipated long timelines. So if I go into a state like Florida, which for years has been known to be 3-year foreclosure timelines on residential mortgages, as that backlog was unwinding this last decade, I know that my resolution timeline on average in the state of Florida is 294 days. So I have been able to squeeze that and create arbitrage, and that's how we're able to get better returns for our investors. So I agree with Brian. It's all about how you're equipped on the litigation side. Now, with regard to states and markets, we may be changing some of our philosophies going forward. The New York City market is a big wild card, given there was already a flight out of those markets, New York, New Jersey, Connecticut, into lower tax states, suburbs, getting out of the big cities. And then COVID came in, and 50,000 people in New York City died. And so who knows what the ramifications of being in a market like that. I agree, from a demographic point of view, you want to be in dense markets where there's a lot of customers to cater to, on the commercial especially. But it's going to be interesting to see how that all plays out. So we too like major metros. We like judicial states. and it's all about knowing each state's laws and their processes.
Speaking of that, I have a quick question because we were looking at New York as well past couple of years. I believe there was a new law that came out in January. I'm trying to understand its implications. I believe it actually allows people to actually raise defenses even after the foreclosure judgments have been passed. Does anybody have thoughts on that?
Yeah, New York is one of the most obviously borrower-friendly states in the country. And not only that, there is a disparity between from judge to judge. So you've got different districts ruling different conflicting results at all times.
Yeah, we actually saw that.
Yeah, and post-judgment, yes, that could be, it's a delayed thing. New York is, we call them deed rats. It's like hand-to-hand combat when you're dealing with borrowers in New York City, because, you're probably not dealing with a borrower usually, because a lot of times there's so many investors going out and buying the deed, knowing that they can control an asset for 3 or 4 years and rent it out. So you've got that whole extra layer. And yes, there's always been blocks, especially in New York, and it's always seeming to be more and more borrower friendly. And of course, the current moratorium on evictions and foreclosures in most states around the country puts a little damper on my day-to-day operation, but we'll be okay.
So how did you guys get around that? You mentioned that you guys got very, very good at foreclosure litigation management and also dealing with borrowers. I personally found dealing with any sort of borrowers in New York very challenging. How did you guys get around that?
Yeah, we have a couple tricks of the trade on the legal side. We have it's a lot of it is about coming to our hearings fully prepared. We're one of the few investors in New York that will send an asset manager and sometimes even the signatory like myself or our CEO to court mediations, because other servicers in large institutions don't have the capacity to manage things on a micro level the way we do. So being very attentive to every aspect, every hearing. But remember, we're buying these loans at discounts. So, if there's a face value that could be 100 or 100 plus LTV, and I might be paying 55 cents on the dollar in Queens for something, that leaves me a lot of room to play. If I'm dealing with the borrower, I can forgive debt. I can put them in a modification. Or I just write them a check and I say, listen, we're going to be honest. You could play this game out, and the only one that's going to benefit is your attorney and my attorney, and they're all going to make a lot of money. How about I write you a check for $40,000 and you sign the deed over? So stuff like that when presented properly, has been very successful for us.
Yeah.
All right. Thank you very much. I have another question, an interesting question from Ariel. Again, and it's pretty general. How do you see these historically low interest rates affecting the cycle this time around?
Luis, you start.
Yeah, I'll start. I think much more importantly than the low interest rates is the amount of money that the government and the Fed are throwing in the system.
Yep.
Last crisis, when the QEs were starting, there was a study by Goldman Sachs that said that each $1 trillion more on the system would be the same as 1% cut on the rates. So since the rates are zero and it doesn't look like we're going to go negative here in the US, the Fed and the government are throwing money that's kind of acting like a rate cut, and we're going to see how that goes in the future. And Another thing that happened last week was the first time in history that the Fed could start buying fixed income ETFs, and they will start buying directly soon in the coming weeks. And also they're going to start lending money to companies.
Yeah.
So I think the rates are not as important as those parts, and nobody knows how that's going to play out.
100%. I'm in 100% agreement with Luis on that. He was going right down the avenue that I was going to say to that question, which is the big wild card here is the federal government, either through the Fed or maybe more spending out of Congress. You know, we used to live in a free market society, and we like to believe that's the case, that we still are in a free market capital society, but we certainly have not been acting like it lately. When you've got the Fed coming in and being the liquidity provider of last resort, yes, it's propped up the markets. Yes, it prevented a major crash and a liquidity freeze a few months ago, but how long can this go on for? And so that's the, maybe depending upon how much pressure that our president can put on Congress and the Fed to continue injecting this fiat into the economy and backstopping, these large institutional investors in secondary and whatnot. That's the big wild card. So because at some point that has to end, and we got to stop kicking the can down the road, and we really have to get back to deleveraging our society, paying down our debts when things are good, and resolving the debts and letting the debts that are bad go bad. And that's how the market. I'm usually not a gloom and doom type person, but there's obviously a lot of gloom on the horizon, and the government is the big wild card here as to whether or not that they can backstop that, and for how long they do, and what the effect would be.
Yeah, and since they've been pumping money since 2009 and didn't stop, I don't think they're going to stop anytime soon.
I agree.
All right. Well, thank you very much. I don't know if we have time for a very last question.
Yes, you definitely do. You have an extra 5 minutes. Please take it.
All right. All right. So we have a question from the audience that says, Seth says, how do you feel about Philadelphia and surrounding suburbs?
I love this Philadelphia for their cheesesteaks. My son is a huge Eagles and Phillies fan, so I think he's got a grandfather that's from Philly. It's obvious, it's one of our original major metros of America, and the historic nature of Philly, the amazing colleges that exist in that town, that means that it has longevity. And it will come back, but it's about to, some of these major cities are going to really experience some extreme stress. We're seeing it already with the food lines that are out there. It's really sad to see how many people are going to really have a lot of pain these next few years. So, as a city, I like it where, we have some investments there, not a ton.
All right, thank you very much.
I just wanted to kind of chime in maybe from the commercial side. Philadelphia, we don't have a lot of investments there, but it does tick many of the boxes that we look for between population density, sales velocity, just the overall population between Washington, D.C. through New York. Population density is just, it's incredibly high in that stretch. And one thing, nice thing about Philly, given that, it's still the 6th or 7th largest city in the country, I believe, by population, and the prices in that metro area, given its size, its proximity, like I said, between Boston, New York, and DC, the prices are substantially lower than those other major metro areas. So, but again, to Bill's point, where prices are today versus 6 months from now, I really don't know, but from an overall macro perspective, if you take the longer term and look at, the type of metro areas that, or the type of characteristics that metro area exhibits, it will likely be attractive for quite a while.
All right. Thank you very much, Brian. And I would like to close with a final question. So we talked about opportunities. However, are there asset classes or, I don't know, real estate sectors that you would like to stay away from for any reason? Who wants to jump in?
Yeah, so from our perspective at Safe Harbor, especially within our funds, we might have separate vehicles for different asset classes, but within our funds, we stay away from hospitality, we're staying away from land and construction deals. And as we said earlier, we take an awfully hard look at retail, and even office would have to be awfully darn attractive at this point.
All right.
Guys, I would say that that it's not a matter of asset class. One should always stay away from bad assets. Bad assets at even cheap prices make no sense absolutely to enter and to even work with. Whereas even if you're paying slightly higher for good assets, I think they always work out in the end. And certainly in uncertain times like this. So that's my advice. Always go for good assets.
Yeah, I would say also stay away from high loan to values, loans with no assets to back it or no guarantees, because probably at some point they're going to be needed in some cases.
Consumer loans, for example.
Yeah, don't do consumer loans if there's no guarantee.
All right. Well, I thank you very much. I think we are running late, so I'll take it back to Michael.
Christian, thank you very much for moderating the panel here on Distressed. Thank you to all of the panelists for your interesting insights, information that you were able to share today. This is a very hot topic, and the debate back and forth was fantastic. So I appreciate you taking the time to go into detail and really drill down. Over the last couple of days, what I've heard is there's a big question of whether or not something becomes distressed or just slightly discounted. So, we look forward to having you back and hearing this conversation unfold. Thank you very much. So with that,